Happy Saturday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. It has been a busy week. We have a lot to cover before we move into what will likely be another busy week next week. So let's jump in. And first up, the Trump administration is preparing to open a high-stakes round of trade talks with China this weekend in Geneva, with expectations building around a possible reduction in tariffs that could ease tensions and provide relief to both countries. Led by U.S. Treasury Secretary Scott Bessent and Trade Representative Jameson Greer, the U.S. delegation is reportedly targeting a specific drop in tariffs, currently as high as 145% on many Chinese imports, potentially reducing them to around 60% or even 34%. U.S. President Donald Trump has hinted publicly that the levies, quote, can't get any higher, end quote, suggesting a political appetite to pull back from the brink. For China's part, much of the last few weeks have shown several key signs that the Chinese economy is suffering significantly, and that there is equal political appetite in Beijing to also reduce tensions. The negotiations begin today, Saturday, with Chinese Vice Premier Lifeng at the table, and while officials stress the talks will be exploratory, there is hope for initial steps towards de-escalation. According to sources familiar with the talks, cited by media in both the US and Europe, progress could yield immediate tariff adjustments as early as next week, something markets were relieved to hear. Key to the US agenda is securing Chinese cooperation on curbing exports of chemicals used to manufacture fentanyl, a crisis that has drawn bipartisan concern in Washington. US officials say China has responded positively to a list of White House recommendations, potentially unlocking reciprocal tariff relief. Additionally, Washington is pressing Beijing to lift its export restrictions on rare earths, crucial for defense and green technology industries, as leverage shifts in an increasingly resource-driven trade war. China, for its part, is grappling with economic strain. Factories have slowed or suspended production, and exports to the US plunged in April. We discussed this in yesterday's episode of my other channel, China Update. Sending top negotiators to Geneva, including Public Security Minister Wang Xiaohong, signals Beijing's desire to stabilize ties. Officials close to Chinese leader Xi Jinping reportedly view limited de-escalation as a necessary measure, even as strategic distrust toward the US deepens. Still, the road ahead remains long. Quote, this weekend is a constructive small step in a 10,000-mile journey, end quote, said Scott Kennedy of the Center for Strategic and International Studies. Trump officials have privately acknowledged a broader deal may take years. The US is not likely to fully unwind tariffs, and China is not expected to make sweeping reforms on subsidies or industrial policy. Quote, each side thinks it holds the upper hand, end quote, noted Andrew Collier of Harvard's Kennedy School, adding, quote, that makes miscalculation very possible, end quote. Yet markets responded positively. The S&P 500 rebounded to pre-tariff levels, and Asian equities rose in anticipation, with political and economic stakes rising on both sides. Even partial breakthroughs in Geneva could offer breathing room, and a glimpse of what détente may look like. Now, let's move to Asia. The Philippine economy grew 5.4% year-on-year in the first quarter of 2025, slightly up from 5.3% in the previous quarter, as strong household and government spending offset external uncertainties. The expansion was largely driven by a surge in consumption and pre-election expenditures, according to official data released on Thursday. Household consumption, which makes up the bulk of economic activity, rose 5.3%, up from 4.7% in the prior quarter. Government spending surged 18.7%, nearly doubling the 9.7% increase seen at the end of 2024. The uptick was supported by easing inflation, which fell to 1.4% in April, boosting consumer purchasing power ahead of midterm elections. Despite the solid start, analysts warned that external risks, particularly the expanding global trade war, could weigh heavily on the outlook for Southeast Asia's fifth largest economy. Juan Paulo Rivera of the Philippine Institute for Development Studies cautioned that trade tensions could stall investment and manufacturing recovery. Quote, while election-related spending and resilient domestic consumption should provide support, the external environment poses downside risks, end quote, he told Japanese financial media outlet Nikkei Asia. Economist Miguel Chancho of Pantheon Macroeconomics echoed the concern, noting that while growth began the year on a firm footing, uncertainty from tariffs may deepen momentum. He added that falling global oil prices may allow the central bank more room to ease further. Meanwhile, Japan's gold exports have soared to record highs, raising eyebrows over their origin as global economic jitters and US tariff fears drive demand. According to preliminary data published on Thursday, Japan exported 281 billion yen, almost $2 billion US, in non-monetary gold, nearly 5 times more than a decade earlier, showing just how bad things are in the eyes of investors. Monthly gold shipments have hovered near 300 billion yen since October, peaking at a record 302.5 billion yen in November. Analysts estimate roughly 20 tons of gold are leaving Japan each month, outpacing 2023's total of 190 tons. Yet Japan is not a significant gold producer. Quote, "There's barely enough to meet domestic demand," end quote, noted market analyst Itsuo Toshima, adding, quote, "This level of export is abnormal." End quote. A key driver appears to be the anticipation of new US tariffs. Following Donald Trump's return to the White House, investors reportedly began stockpiling gold in New York, with the UK-based Financial Times citing increased movement since late 2024. In turn, this has prompted the release of gold inventories held in Japan. Authorities suspect much of the gold now being exported was smuggled into Japan to evade a 10% consumption tax on imports. Smuggling surged after Japan's tax hike in 2014, and has rebounded post-pandemic, with 1.2 tons seized in 2024 alone. While gold remains a safe haven asset amid market volatility, the murky origin of these shipments poses regulatory challenges. Officials are calling for tighter oversight not just at the border, but also on outbound flows, as Japan's gold trade draws global scrutiny. Of course, this is all part of a shifting global order. If you want to be on top of all the developments related to this historic change, consider subscribing to Market Update, hit the bell notification icon, and you will be getting some value from today's episode. Don't forget to hit the like button. It's just a couple of clicks of the mouse, but it's a tremendous help for the channel and its growth. Thank you so much. And finally, we now move to Europe. US President Donald Trump on Thursday unveiled what he called a breakthrough trade framework with the United Kingdom, marking the first such deal under his sweeping global tariff reset. The limited agreement, still pending final negotiations, lowers barriers for American goods while granting the UK favourable access on select exports, a strategic win for both leaders amid rising global trade tensions. Speaking from the Oval Office with UK Prime Minister Sir Keir Starmer on speakerphone, Trump hailed the pact as, quote, "a tremendous trade deal for both countries," end quote. Starmer called it, quote, "a really fantastic historic day," end quote, noting the symbolism of the agreement coinciding with the anniversary of the end of World War II in Europe. Under the framework, the UK will fast-track US agricultural, chemical, energy and industrial exports through customs and offer reduced tariffs on beef and ethanol. In return, the US will lower tariffs on British steel, aluminium and autos, with UK-made vehicles allowed in under a reduced 10% tariff, down from the previous 27.5%. A tariff-free quota of 13,000 metric tons of US beef will also enter the British market. Wall Street welcomed the announcement, with the S&P 500 climbing 1.5% amid hopes that the agreement could become a template for future deals. Trump predicted more market gains if Congress extends his tax cuts, urging Americans to, quote, "buy stocks now," end quote. While the deal is politically significant, economically it remains modest. Trump emphasized that the 10% rate for UK autos would not serve as a benchmark for other countries, warning, quote, some will be much higher, end quote. The UK, which exports more to the US than it imports, stands to benefit in niche sectors. High-end auto brands like Aston Martin and Jaguar Land Rover are expected to gain from the tariff reduction. Rolls-Royce engines and parts will enter the US duty-free, and a British airline is expected to purchase $10 billion worth of Boeing aircraft. Still, gaps remain. The two sides differ on how to treat digital services taxes and the full removal of metals tariffs. Talks will continue on pharmaceuticals, semiconductors, and advanced technology collaboration. The agreement, years in the making, falls short of the sweeping trade pact once envisioned post-Brexit, but signals a thaw in Trump's confrontational trade stance, and a win for both countries. Quote, "It sets the tone," end quote, said Commerce Secretary Howard Lutnick, adding, quote, "for reciprocal trade going forward." Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Saturday, have a restful weekend, and I will see you for a new week of updates on Monday.